Hey, everybody, welcome to another episode of the Under the Hood podcast hosted by Stallion Capital. Today on the show, we have Daniel Goodman, who is the Director of Financial Planning at Sierra Pacific Financial Advisors. Daniel, how you doing today?
I'm doing well, Tim. How are you doing this morning?
I am doing fantastic, and we look forward to getting to know a little bit more about you and your firm. So,
Excellent.
just talk to us more about your kind of foray into the financial space, a little bit about your backstory, what made you make the decision to jump in, and kind of some of your experience there.
Okay, cool. Yeah. So, just so you know, like I did check out one of your previous podcasts, and the guy on there like had like the fighter jacket, stealth fighter patch. I am
Yep.
not nearly that cool. Just so everyone knows that. Let's see. So I received my master's, my MBA from Santa Clara University out here in Santa Clara, California. So this is where we're at, Northern Bay Area, California. And so I started my financial career after that in corporate financial planning and analysis. So I did that for a number of years, and then I decided I wanted to do something different. So I started my own little business. I owned a home beer making and wine making shop in Livermore, California, where I still live today. So did that for about 8 years, and then decided to close that shop. And then the question became, well, okay, now what am I going to do? Like I have this knack for working with data, but I also really enjoy meeting with people, hearing their stories, and kind of what are they trying to accomplish. And then as a Christian, I'm really all about helping people and how can I serve. So it's like, well, how do I take all of that stuff and how do I put that all together? Well, personal financial planning just kind of really fit the bill for that. And I did start my career at Northwestern Mutual, so selling insurance. So it's a great thing. I'm a chartered life underwriter, by the way. So I still lack myself some insurance and stuff like that. But I'm also a chartered financial planner as well now, and I've been in the personal financial planning space for about 12 years now. So really enjoying that, and again, helping to meet people, helping to you know. What are their goals, what are their plans, and helping them to achieve them. So that's kind of the career path that I've been on and how I got into the industry.
I gotcha. That's a little bit of jumping around. I didn't expect the kind of 8 years of kind of small business ownership in there, but that's really cool. What made you kind of decide to close that down and move to the next stage in life?
Okay, well, things in our life, we have plans, and sometimes they don't always come to fruition. So the shop did okay. I had a good core of customers, and then it just became one of those things where it just wasn't going to be sustainable, unfortunately. It was a lot of fun. I met a lot of great people, but in terms of like what the future is going to hold, I have three daughters now, but at the time I had two daughters, they were fairly young, and it was like, well, how I'm a single dad, how am I going to support two kids? So the decision was like, well, we need to do something that's a little more financially viable. And so that's how we kind of, and I only have ever really done finance. So it's one of those questions like, where you're like, well, I need to do something different, but what's my skill set? What am I good at? And, meeting people and greeting people and getting to know them was definitely one thing. Um, but also like this finance thing, I just have a knack for it, and working with data. And so if that's where my skill set lies, well, then, and that's what my gifts are, well, then that's what we need to leverage. And so again, like I said, how do I bring those two things together? And then that's what led me into personal financial planning.
You've been doing it for 12 years now.
Mhm.
What is your favorite thing about it?
Oh, that's easy. I love putting plans together.
Hmm.
It's and I love meeting the people. So those two things really go together because you can't really put together and have fun building a plan if you don't understand the person or the couple you're trying to put it together for, right? But like my mother was always big on jigsaw puzzles when I was growing up. Like whenever I would come home from school or whatever, there'd be like a new jigsaw puzzle on the kitchen table that she was always working. And I look at financial planning a lot like that. I think it can be a lot like a jigsaw puzzle because we have all these parts. We have, qualified accounts, retirement accounts. We have taxable accounts. We have cash. We have a pension plan potentially. Clients want to own a scuba boat in retirement, or maybe they want to buy a small island. I don't know, but it's like how do we take all those parts and put them together? And that's where the data part for me really comes forward, is like starting to work with the data, interpret it. And as I'm going through all of that and kind of doing my data checks and my reasonable tests, it kind of starts to come out, like how that plan is going to come together based on what the client has told me. So for me, anyway, there's like an evolutionary process through the planning that I really enjoy. Kind of like a sculptor. He has like a block of marble and has an idea like what it is, but it doesn't. But until they're done, they don't have that shape. And as they're sculpting away, the shape comes out of the marble. So for me, financial planning is a lot like that. That process for me.
That makes a lot of sense. Well, where do you go to kind of stay up to date on current market trends and the latest financial strategies?
I read a lot. So part of the beginning of my day is I just check out like what's going on in the market, what's going on in business, what's going on in the economy. So I really try to stay very topical. Like I do that every day, and I have my favorite websites that I look at and stuff like that. And then also what's going on in Washington, because what's going on, excuse me, what's going on in Washington can have a real big impact on what's going on in the market and how it's going to impact my client. So I spend a lot of not a lot, but I spend a fair amount of time kind of looking in the morning and making sure what's going on, staying on top of that. Plus, there's always webinars out there. I don't have a
Mm.
lock on good ideas. So I really do enjoy listening to other financial advisors and other planners. What are things that they're doing? What are tools that they use? Are there opportunities to implement some of those things in my own practice with my own clients? And then also, like I mentioned, I'm a chartered life underwriter and I'm a CFP. So, of course, there's always continuing education requirements that we have to take into account.
Yeah, the continuing education can definitely come in handy when you're looking for, the latest financial strategies, just staying up to date on stuff, reading a lot. I know Warren Buffett does that for like 6 hours a day. So I think you're in good company there.
Well, I don't read as much as Warren Buffett, but he's got a whole lot more money than I do, so he can afford the time.
There we go. There we go. I'm a little bit curious as to where you're finding some of the seminars. Obviously, you have continuing education stuff, but specifically when you're listening to other financial planners, where are you finding that? Are there certain groups? Are there certain planners you like to follow? Or talk to us a bit about that.
Well, Griffin Capital, and I'm not trying to pub any particular firm, just so everyone's aware of that. They've got some stuff, and then CMAC is one. I think it's CMAC, I believe. They're really good on economic type stuff. It can be a little info dense sometimes, but that's pretty good. And then I just get a lot of stuff like the NAPFA, NAPFTA, I think it is. The
Mhm.
NAPFA folks, because we're fee only RIA, right? So we're members. They have a lot of stuff that they will put out during the course of the month and related to stuff, and that's pretty good. Again, not pubbing anybody, but Holista Plan also has some pretty good webinars that they do. So I enjoy some of their stuff. I'm learning more about tax because honestly, I mean, you guys will probably know. I mean, that seems to be everybody's number one thing. That's their number one pay point is how do I deal with my taxes? What can I do there? So I
How
really,
do I deal with my silent business partner?
yeah, right. The one who keeps his keeps their hand in our hip pocket. Yeah. How do I
Yep.
do that? I always tell people, look, I am fine paying taxes. I will pay my fair share. I got no problem, but I don't want to pay any more than that.
Mhm.
So how do
Yep.
we go about how do we do that for our clients? And that's a big thing for me too. Is like always trying to be more educated, try to stay up on what's going on in that part of the planning business. Is like how do we help our clients around taxes and how can we help them be more tax efficient?
Yeah, I'm curious your take on this. Some people have said that just given where the nation's debt is at and our ability to cover our debt,
Mm-hmm.
taxes may have to go up at some point in the near future.
Yep.
Do you see that happening? I know it's hard to like, I'm not asking you to speculate and come to a firm answer, but just speak
Right.
to the issue for me.
Yeah. I mean, okay. Here's one thing I've told people before, and it may not feel like it, but we're in a low tax rate environment. So if you I know, right? So if you think back to 2017, our tax brackets were a lot higher than they are today. Corporations paid, I believe, I want to say like 38%. Now, don't quote me on that. I could be wrong, but they were paying a higher rate than they are today. in comes the Tax Cuts and Jobs Act of 2018. What that did, it did a lot of things. But one of the things it did is it compressed all of the tax brackets, as well as making changes to the standard deduction and the ability to itemize, right?
Mhm.
So if Congress does nothing, and without making a political statement, they seem to can't do anything these days. But if Congress does nothing, the Tax Cuts and Jobs Act will sunset at the end of 2025. When that happens, everything goes back to the way that it was. So if that happens, we're actually going to be in a higher tax rate environment than we are today. Will Congress do something to, try to keep some stuff of the Tax Cuts and Jobs Act in place and let others lapse? I don't know. I know there's bits and pieces they're talking about. Of course, the Republicans in Congress want to keep the tax rates where they are, and I think they actually want to enshrine them like forever, as much as you can do anything forever in Congress. Whereas the Democrats want to say no, we need to get things a little bit up because, and I forget the exact number. I want to say it's like 38 trillion or 34 trillion is the debt's the largest it's ever been.
Yep.
Um, you know, yeah, something's got to give. And I probably would think there's got to be something to be done. I'm not a big fan of higher taxes, but you got to do something to figure out how you're going to balance that budget. And without going too far down into the rabbit hole, Tim, it's one of those things where something's got to happen. I mean, we got to figure out how can we stop spending as much as we're spending, but also increase that tax base. And there's talk about, well, we need to tax the upper 400 or the upper 1%. I mean, we'll see if there's political will to do that. Um, but yeah, I think some things will be done. I just can't tell you what, but I do know we can't keep spending the way we've been spending.
Just gotta decrease expenses and increase income, you know?
Just like a household, right? Oh, hey, I
Yeah.
got it. The federal government should hire me as their financial planner. I'll just sort it all out for them.
There we go. That would be a huge client for sure.
A little bit.
Yeah, that's cool. Well, let's go ahead and jump into kind of insights on the current market.
Yep.
We've kind of spoke about the government a little bit. When you speak about the government, most time the Fed comes into play. And
Yes.
what are really some of the most important factors you're paying attention to in today's market? And what's your high level strategies to
Right.
address them?
Well, we already kind of talked about the one, which is Congress and the budget. They've got to do something. I mean, so the fiscal year for the federal government starts. I think it's either September or October,
Mhm.
and we don't have a budget. They've been working on it since last summer. We've had continuing resolutions and we barely avoided government shutdowns. We're 5 months, 6 months into the fiscal year. We still don't have a budget. And now there's talk about just using continuing resolutions to get us through the rest of the year. And then we already talked about the budget deficit, right? 34 trillion. Congress has got to figure out what they're going to do, right? What can we do as an advisor? Because obviously there's not much we can do about the stuff that's going on in Congress. I think what we need to do is we need to realize that 2024 is just going to be a year of uncertainty and volatility. If you look at the VIX index or the volatility index, it's
Mhm.
been on the rise since I want to say November of last year. So we're seeing more volatility in the market. I think that'll continue. So I think on a high level, where we're trying to be at is try to be a little bit more defensive in our equity sleeves, to try to minimize as much variation and volatility as we can, and then just be ready to pivot later in the year if we see some good opportunities. The other thing is, and you mentioned it already, Tim, was the Federal Reserve Board. I've been a Federal Reserve watcher for quite a while. It was just something that always piqued my interest when I was in college, and now as I'm a financial advisor, I watch them a whole lot more. Um, so when it comes to the Fed, the boogeyman in the room is interest rates. Now I think that the Fed got it wrong with inflation, calling it's transitory and all that. That was the worst word they could have probably ever used. But in their defense, I think they were in a bit of an environment they'd never been in. I mean, we were post COVID, and we had unprecedented levels of government just shoving liquidity into the economy, and then they were trying to figure out how to deal with that. Um, but Chairman Powell and the Fed, they've taken a pretty hard stand against inflation, and I don't think that's something that really going to stop doing too much. I mean, obviously, I don't think rates are going anywhere. But what the Fed has been doing side by side with the rates increase they did in 2022 was what's called quantitative tightening, and that's just where they're letting the treasury debt and mortgage-backed securities and things like that they have on their balance sheet just basically roll off. And so what that means is they're basically selling these things, which takes money out of the economy. So that's another lever the Fed has to restrict economic growth. And in the minutes from the last meeting, they actually addressed this whole issue. And so, they're looking to slow the amount of quantitative easing or quantitative tightening, excuse me. But they're not saying they're going to stop. And since June of 2022, they've actually allowed almost $1.3 trillion to roll off that balance sheet. So the Fed is still in the fight for inflation. And I just don't think they're going to be taking their foot off that pedal anytime soon. A lot of people smarter than me keep saying that they're going to be cutting rates sometime in the next couple of months. Like now, I guess they're thinking May or June or something like that. Me personally, I don't think it's going to be until the back half. Chairman Powell and the Fed governors have all said pretty much we're only going to do three, and we're all going to be in the back. So there's, like I said, there's a lot of smarter people out there than me that are betting it's going to be earlier than that, and there's going to be, I think they're saying now four since the March one has been taken off the table. But I think the Fed just isn't ready to undo all the work that they've done. So I think they're just going to they're going to want to be sure that inflation is trending back down to 2%. And if you look at the data, the labor market is still strong, prices are still sticky up, and there's been movement, positive movement. I just don't think it's been enough.
Mhm.
And so, yeah, so the second part of your question, we're staying in short duration treasuries for the most part. So basically under 12 months, because that's where the yield curve is around 5% right now. And then after you get to about 12 or after you get past 12 months, the yield curve kind of falls off a bit of a cliff. So we're trying to stay a little bit short, and government agency bonds, again, that same duration, are pretty good. And in terms of like corporate debt, I don't think the risk premium is there for those yields just aren't enough for me to want to take on that extra risk. So again, kind of boring, kind of defensive, but that's kind of where we're at in trying to deal with what the Fed is doing in terms of interest rates.
All right. I like the strategy about, staying in the short term to capture those yields because everybody's about good yields. But I am curious specifically to risk. How are you looking at, addressing risk management given the current state of the market?
For right now, when we talk about the fixed income sleeve section of a portfolio, yeah, we're staying somewhat short, under 12 months. It's not the sexiest of investments, but again, the yields are okay relative to the amount of risk that we're going to take. The thing, it just takes a little bit more management because you have to be a little more active because you're trying to pay attention to what's going on in the 3, 6, and 12-month timeframes. But also, I think for some investors, not all, but for some investors, I think there's some opportunity in the private debt space. So in here, we've seen an increase in private debt placement as more traditional debt funding has gotten a little more difficult and underwriting has gotten a little tighter. And so for folks that are interested in this particular source, I really just tell them you want to be really diligent and do your research and understand both the credit quality and what kind of debt you're getting. Are you getting senior debt or are you getting subordinated debt? Because these things are going to make a difference potentially if there's some downside, right? And while I do think we've avoided a true recession, I think we've navigated those waters. I still think there's some cash flow pressures that are in the economy, and especially with those businesses that find it more difficult to get some of those traditional lending sources. So you just want to make sure you're doing your due diligence. The other thing in terms of risk management, and I'm going to sound a bit like a lone wolf out in the cold here, is I would be cautious of those large cap growth stocks right now and growth funds. Um, and mainly because I feel that they're a little overbought right now. Because if you go back to 2022, the growth of the NASDAQ was really centered or focused on seven stocks, and that was it. The rest of the NASDAQ was not up nearly as much as those seven. So there wasn't a lot of breadth there. Um, and I also, and we kind of seen this in the last couple of weeks, we've seen some weakness in the NASDAQ. Although today, NVIDIA reported earnings and they're up a ginormous amount and they're bringing the NASDAQ along with it, right? Because that's how it kind of goes. Um, but I think it goes back to our discussion earlier about interest rates and interest rate cuts. Because you saw in March, or actually, no, in January, February, when the Fed last met, and they said, no, we're not cutting rates in March. Well, what happened? The broader markets all went down. So I think we might see something similar up until maybe the mid half of the year. So I'm probably a little bit of a contrarian. Um, I would be looking at from a risk management perspective, which is what I'm telling my clients. Let's look more in the large cap space, value and blended space. Let's look there. So we get a little bit of protection on the downside because these things don't really move a whole lot. And if it's a value stock, they're not that interest rate sensitive because they have a lot of cash because they're paying dividends and all this other kind of stuff, right? But with that being said, I would be ready to pivot to the growth area, large cap, mid cap, probably around the middle to latter part of the year. But yeah, that's where I'm at right now. Let's keep duration short, and let's stay a little bit defensive on the equity space around value stocks and blend. So the ones that aren't growth, basically, yeah, and in the large cap space.
Yeah, that makes a lot of sense. So on the fixed income side, kind of staying short term for like bonds and such. You're also maybe recommending some private credit, private debt for some of those high net worth people, or just for some diversification, for some income. And then on the kind of large cap side, maybe steering away from the growth stocks until later in the year, some second half of the year, and sticking to those kind of value stocks and large cap in the large cap space.
Yeah, and I probably wouldn't leave the large cap growth space 100%. I don't. I would probably leave my toe in the water there at least a little bit, so you get some upside capture. But if you're going to say I'm going to hold 20% of my portfolio in large cap growth, I would probably counsel against that.
Okay, so when you're looking at constructing a portfolio, say it's for accumulation, right now you're um, decreasing what maybe a typical allocation to large cap growth might look like, and maybe you're doing some value add there. But then when you're doing a kind of income portfolio construction, kind of just take us through the specifics of those because you threw out a 20%. What are some general guidelines for each one when you're in accumulation phase and when you're in income phase?
In the accumulation phase, yeah, you want. So first of all, let me say that every client is unique, and so every portfolio construction has to be unique. So we're going to talk in some very broad, broad terms, right? So in the accumulation phase, especially if you're younger, so if you're like in your 30s, early 40s, you've got a long runway into retirement. So you can carry extra equity risk. So you can be maybe 70 or 80%, depending on your appetite for risk and in equities, right? And are there other sources of capital that you've got? So, for example, if somebody has a cash value life insurance policy or they have an annuity, there's some cash value there, you have the ability to take on more risk in your equity portfolio because you've got another asset sitting there. Because remember, annuities and cash value life insurance, it's not an income thing. It's a balance sheet item. It's an asset. For folks that don't have things like that, then probably you want to take a little bit less risk, but you still want to have a fair amount. Like, again, it depends on everybody, but maybe up to 60, 70%. If you're even younger, like maybe you're in your 20s, maybe even upwards of 80. But let's not get too crazy. And then within that, So if we're going to, so let's just focus on the equity sleeve, because the fixed income sleeve, 20% of that, you pick your favorite aggregate core bond fund, AGG or something like that. It's not sexy. It's boring. It's not going to do a lot, but it's going to give you some of that downside protection when everything else is risky. So in that equity sleeve, now we're looking at, well, how are we going to allocate our assets? And there's a difference in allocation between a taxable account and an IRA, a retirement account, or your 401k account, right? In your taxable account, if you're in a lower tax bracket, you can probably go ahead and have part of the have a corporate bond fund component to that, because if you're in a lower tax bracket, the tax you're going to pay on that income is pretty small. If, however, you're in a higher tax bracket, muni funds and ETFs start to make a whole lot of sense. Generally, with the clients we work with, that's usually what we're recommending, because once you do the after-tax math, the muni funds make more sense, even though maybe they're only returning 2 or 3% in terms of yield, right? Because they're not taxable. That's why we love muni bonds. They're not taxable at the federal level, nor are they taxable at the state level, as long as the muni bond you're buying is in the state in which you live. So that's the thing to remember there. So yeah, if we're talking a taxable account, we like muni bonds or muni bond funds because they kick off tax-free income to you. ETFs are also very nice because, unlike mutual funds, they're not required to spin off capital gains and interest income during the course of the year. Because remember, that's all taxable stuff. Even though it gets reinvested, or even if a dividend, like you own Apple, and Apple pays you a dividend, even though you don't take it, put it in your bank account, it gets reinvested. That's still taxable money to you. That's still a taxable event. ETFs don't do that. They spin off very little cash over the course of the year. So we want to be tax efficient in those taxable accounts, especially for our high net worth clients. In an IRA, your qualified accounts, that's where you can have all the fun stuff. So if you want to do, like a private credit, an IRA is a great place for private credit because all of that income that gets spun off doesn't get taxed. If you're going to have your high dividend earning stocks or stock funds, IRA again makes a great opportunity for that. So your mutual funds are going to be in your IRAs and your 401ks. Your ETFs and muni funds are going to be in your taxable accounts. Okay, then we transition to decumulation, or the income phase, like you called it. So now we're going to kind of start flipping that house a little bit, right? We're not going to have 70% equities and 30% bonds. We're going to have something that's a little bit different. Maybe it's 60% fixed income and 40% equity, or 70% income and 30%, whatever that might be. Again, it depends on your situation. Because when we get to be retirees, one of the things we're looking at, most retirees are about income. They don't want to lose their money, so they don't want to have like zero growth. But the big thing is, how can I pay my bills month to month? And so that's where we're going to make that shift to things that are more income producing. And I already mentioned private credit as one of the things you can do. Oh, the other things we can look at too are private real estate funds. The cool thing about private real estate funds is, depending on how they're constructed, those distributions are considered partial return of capital, and those are not taxable. So always things to look at there. The other things we try to do in the income phase is try to help our clients have a balance between their portfolios. Like the IRA balances try to be similar to their brokerage accounts or taxable accounts, because that gives them flexibility in where to choose to withdraw money depending on their cash need and what their tax situation is. So if you have that flexibility, it gives you a lot better tax management ability than if you only have an IRA or you only have a brokerage account.
I do want to jump into alts. We've mentioned private credit. We mentioned private real estate funds. So how do you go about evaluating alts in today's environment? Are you looking at the manager? Are you looking at the kind of downside first, the concentration of the strategy? Talk to us about that.
That's actually a really great question. So we've been a believer in alternative investments for quite a while. Well, let me walk that back just a wee little bit. Prior to 2021, you could throw a dart at the stock page or the mutual fund page, and you were going to make money. it was really easy. And so it was like, oh, I want to be large cap growth, I want to be some small cap growth, all of this stuff, and we're going to do well. Well, what we saw in March of 2020, and then in 2021, market down 30%. 2021, I start to get my years confused a little bit. I'm getting older. Sorry. You can see all
All
the
good.
gray right there. But what we saw in those down markets essentially was that we need to do something a little bit different. We need to do something that's countercyclical to the market. What is that? Well, that is alternative investments. So the first thing we want to look at when we're talking about alternative investments is this idea of what's called correlation. What correlation means is I have two things, and if one moves, how does the other move? So and correlation, not to get too much into the math, but correlation is measured on a scale of 1 to -1. +1 is perfectly correlated. So if one goes up 10%, the other one goes up 10%. If they're -1, if one goes down 10, so starting at 0, if one goes down 10%, the other one goes up 10%. Okay. Generally, investments don't have either fully positive or fully negative correlation, something in between. So when we look at alts, what we want to see is low correlation to the broader market, so that if the market's going to be down 20 or 30%, like we saw in the last bear market, those alts are going to give us some buffer. So instead of being down 30%, maybe we're only going to be down 15, or maybe only down 10. Also, they tend to give you a little bit extra return. So where we started with alts was we looked at just broad basket commodities, and we looked at some real estate, and then we looked at some inverse ETFs. So and we were kind of really learning how the alt space really what was working. Lately, what we've done is we've really started looking at more private equity space, either be it private credit, which I've already talked about a little bit, private real estate deals, and private equity, because these all offer great historically, because history is no promise of future return, but these have all offered pretty decent returns. And private credit has actually outpaced, in terms of distribution, public debt yields. So we're really working a lot more with that. And a lot of our clients have been really happy with the results for that. So I guess to answer the question, I guess that's where we really look first is correlation. How does it work? And then depending on what the vehicle is, then what's next? Like for private real estate funds, the things we want to look for there is what's the underlying investment, or for private equity real estate debt, what kind of loans are being made, and what's the quality of that? Because again, if we can keep if we know there's pretty high quality underneath all of that stuff, then we know that fund is going to should do pretty well. And with private real estate, we like places or funds that invest in newly or moderately already gentrified neighborhoods. And the reason we tend to like those types of funds is because we're already seeing a resurgence in that particular neighborhood. So we have an economic base that can support further growth. And so that takes less risk for that real estate fund, that private real estate fund. The other thing is we really like about those alternatives is the liquidity premium that you tend to get, because a lot of these vehicles are semi-liquid. So we're able to get a little bit extra boost on return and distribution income because of that. Now, of course, again, like you alluded to, Tim, it's not for everybody, but for those clients that are able to say, yeah, I've got $500,000 that I can put away, and I don't necessarily need that right away, this is a good place to go. And again, it gives us a little bit of cushion on a downside market.
Yeah, no, that makes a lot of sense. We've so Stallion Capital in that private credit space, or specifically private real estate debt, and we've had a lot of advisors and a lot of people come to us for that reason of like we are not correlated. Like when the market dropped, everybody loved Stallion because we had
Yeah.
that kind of Texas backed real estate loans that were still pushing out yield when everything else was negative. And so alternatives can really be a great spot for that kind of diversification, making sure you're not correlated and just smoothing out that yield, right? You might get 20% in equities or negative 25% in equities, but if you're consistently getting 8% here, or maybe you have a project where it's like a syndication or something, which Stallion doesn't do that, but there are plenty of people who do syndications. You might be getting like a 15% IRR, but your money's away for 5 years. It'll just
Mhm.
smooth out your return profile over that time period, given the project's successful, of course. So
Yep.
that's when you got to really dig into the due diligence of, hey, is this, which is exactly what you said, Daniel, is this a good product under um, kind of the fund? Is the foundation solid?
Yeah, 100%. I mean, you can look at the same thing with a qualified opportunity zone. Um, those can be great if you've got someone who has a large capital gain that they don't want to pay tax on. They want to kick it down the can a little bit. But if you're going to lock up your money for 10 years, because that's what some of these QOZ funds are,
Yeah.
one, you got to make sure you can afford that. But two, it's like know what they're investing in, because if you want to lock up something for 10 years, you want to make sure you're going to get some nice return at the end of the day, right?
Yep.
So yeah, the private debt funds, we do like them. We do, because like you said, they're consistent. And if the underlying asset is quality, no reason not to put some of that in a portfolio. And we've done anywhere between 5 and 12%, depending on the client and the situation and what the fund looks like.
It's a good spot to be in. And, usually the next question is the role that alts play, but I think it's pretty clear now that the role is, hey, it's not correlated to the market. It's a consistent stream of income, can even increase yield in some cases,
Mhm.
and it just really smooths out returns because of that
Yeah,
uncorrelated nature.
yeah, I agree 100%. And I don't know what the numbers are. Someone can look it up, but the growth, yeah, I think even in private debt, I want to say from like 2005 to like 2022, it was like 1.4 trillion, and now it's like almost 4 trillion.
Yeah,
So that's a pretty short time frame to more than what, quadruple or triple the
yep,
amount of investment, and that's just private debt. I doesn't even talk about private equity, which is its own beast. I think the percentage is like of the companies that are out there that are privately held, 85% of them are private.
yeah.
That means only 15% are public that you can go buy on the market. So that's a huge like opportunity for people to get into, right?
Yeah.
Again, it just, you have to have the right fund with the right underwriting and the right risk metrics, and do your homework, do your due diligence, or hire a great wealth advisor. You can do that too.
Yeah, yeah, no, absolutely. There we go. Well, cool. I think we covered a lot on alts there and kind of how you go about looking at them, what you're looking for them to do in a portfolio. But what are some emerging alts or current alts that aren't emerging that you just want to learn more about, not to endorse them, but just to say they're interesting enough to give a second look?
Um, so again, not trying to pub any particular fund or company or anything like that, but I keep looking at Blackstone, and their stuff. I really like their what they call their B REIT, and I like it because it's a pretty high quality underlying investment. And so that's good, because I like that. I have a less risk of losing my clients' money because they work really hard for it, right? And it's got a pretty good distribution. I want to say it's like 8 or 9%. I could be a little bit off, but I think it's about like that. And the returns are pretty good. I think the returns are like 12%. I don't ask me over what period, because that part I don't recall. That might be from inception date, and I want to say the inception was 2007, but again, don't quote me. I could be mistaken. Um, but the thing that I like about it is, especially for our, like I said earlier about our brokerage accounts, is the way that's structured is it's a partial return. A majority of it is a return on capital. So for those you tax professionals that are listening today, when it's a return on capital, that's a non-taxable event to you. So you get money back that you've invested. You get that back, like that, let's say that 9% distribution. 85 or 90% of that could be non-taxable to you. So that money that's flowing into a brokerage account, you get to take that right to your bank account and go have a great night on the town with your partner, right? So I do like that. And then I don't have any particular private credit fund I'm like a big fan of, but just the general idea. I really do like that, and I do like it for our clients' qualified accounts because they do spin off. Again, you need to just get them the right fund, make sure it's all airtight and has a good risk profile for your situation. But they can spin off between 12 and 15% yield. And if you're looking at, we just talked about the treasuries turning, spinning off 5%. So this is a huge number, and it's taxable income, which is why you want it in your IRA. You don't want that in your brokerage account. Um, but I think that's a great opportunity, right there. And then, so I think those would be the one particular fund that I like, and then just as a general category of what I like right now when it comes to alternatives and private investing.
I want to jump back to your firm and you, just a little bit more about you. Um, how do you feel like people can really tell you guys apart from other financial advisors?
So we're a boutique firm. There's only five of us, and I said earlier, we're located in the San Francisco Bay Area. We're about 50 miles, kind of southeast-ish of San Francisco. Um, we've got about 160 million dollars assets under management. Our average portfolio is about 1.6 million, something like that. And typically we work with executives with equity compensation because again we're kind of just right there here in Silicon Valley. So Apple, Google, Meta, all those fine folks, they get restricted stock units, incentive stock options, stuff like that. So we have a real skill in helping clients that have those types of opportunities. And we're getting more and more clients who are working with pre-IPO. So trying to help folks understand what are some tax strategies that they can implement with these pre-IPO companies because it can save them a lot of money. Um, so the other thing is, I think being a small firm that sets us apart is you always know who we're going to talk to. So whenever our clients call in or they drop by the office, they pretty much know they're going to talk to myself or Janet or Jacob or you, right? So there's a real personable uh, feel to the firm. And then I think again, it doesn't uh, necessarily unique to us, but we're a fee only RIA. And I really like that because the freedom of being fee only and an RIA at the same time is we're not beholden to any one particular company. So any recommendations that we make to our client, we know that's an unbiased recommendation and it's in the best interest of our client because there's no reason, there's no kickback or anything like that. There's no conflict of interest. So, and as a CFP, I take that fiduciary standard very, very seriously. So, whenever I'm working with a client, anything that I'm going to do, I'm going to put work and effort to make sure it's absolutely the best fit for them and their situation, and what they've told us. And we don't believe in cookie cutter solutions. Um, from an efficiency standpoint, I get why firms do that. If you've got a couple hundred, 300 households or whatever, it's very easy to say, pick from column B, pick from column C, and here you go. It's very easy to manage that way. We don't do that. And so even though we're a small firm, we give our clients that personal touch. And I think that's what they really hunger for. People work hard for their money and it's important to them, whether it's 3 million, 2 million, or $500,000. That we're committed to working just as hard to be sure that we're doing right by them, and we're being good stewards of their wealth. So that's kind of how we, as a firm, approach working with our clients.
And what do you think is most important to that client advisor relationship?
That is an easy question, my friend, and that's a single word: trust.
Hmm.
Trust is the most important thing between an advisor and a client. Let's be honest, right? I started Northwestern Mutual. God love them, right? Selling insurance. Do you know how hard that is? Insurance guys have a bad rap because we've all heard the phrase: "A few bad apples spoils the whole
Yeah.
bushel."
Mhm.
And it's the same in insurance, and it's the same in wealth advisory. Um, somebody has a bad experience. Like I just met with a client prospect just the other day, and the reason they were coming to us is because they felt like they got kind of messed over a little bit with their prior advisor. So as advisors, what we need to do is really show the client that, or the prospect, that we're we're not only are we listening to them, but that we're hearing them, that we're really hearing what they're saying. And so we need to find out what motivates them and what their values are and what's important to them. These are the things we need to do. Because only then, when we do that, can we help them to realize their goals and ambitions. What are those things they really want to do? Like I mentioned, the scuba boat earlier, and that's a true story, by the way. Um, so the client really needs to know that we care about them, we care about their families, we care about the things that are important to them, and that's what builds trust, because it shows that we're listening and that we care, and that comes about by how we put together their financial plans and how we go about managing their wealth. Um, and we show that too by having transparent and honest investment reviews. It's one thing that, back again when the market was down 30% in 2020, 21 or whatever, I would tell my clients, like, hey, I'm not going to hide behind the numbers. We're going to go over this. And unfortunately, yeah, I'm sorry to say your portfolio's down 18%. This is why, and this is what we're going to do. And people appreciate that. They appreciate that honesty, that you're not trying to, you're not trying to do some smoke and mirror kind of thing to make it look like it's better than it really is. Because people are not stupid. They know when things aren't going well. So just be honest with them. Be transparent. Um, and then, I would tell you, we need to maintain an ongoing dialogue with our clients as we manage their wealth. We can't. I don't want to do that in a vacuum. Even though we have discretionary authority to trade and all that, and we can do all this and that. I take pride when I have a major rebalance or something major I want to do with my client. I reach out to them and we talk it over and we make sure we're all on the same page. Generally, my clients are like, okay, Daniel, yeah, you go do that. Sometimes they're like, well, can we tweak it a little bit? And we kind of go through that. And then we're working together. It's collaborative, right? And I think when we do that, when we do all of that stuff sincerely, then we're going to be able to grow our firms organically, because that client is now going to become our biggest advocate. And that's what we're after. So, yeah, that's kind of how I think that's what's important in my world, in my view, is that trust. I don't think there's anything more important than trust between your client and yourself as the advisor.
There we go. Well, Daniel, I think that is all we have for you today on the show. Where should people go if they want to find out more about you?
Oh, that is very simple. Our website is, pencil and paper, everybody, www.sierrapfa.com. Paul Frank Apple. Um, you could also always call us. I'm going to have to look aside because I always forget the phone number. It is 925-223-8868. And you can ask for Daniel. Our principal is Janet Wan. She started this company almost 20 years ago from zero. No clients, no portfolio, no nothing. And here we are today, almost 20 years later, again, $160 million in assets under management, and we're going strong.
Well, cool. Daniel, thanks so much for coming on the show. And everybody else, thank you for watching. All the ways to contact Daniel will be down in the show notes. And we will see you guys on the next one.